Welcome to The Explainer. All right, today we're tackling two numbers you see in the news constantly, unemployment and inflation. But we're going to go way beyond the headlines. We're going to peel back the layers and see what these big, abstract numbers actually mean for your wallet. So, let's just dive right in. I mean, you see that unemployment number on the news all the time, right? But have you ever really stopped to think about what that percentage truly means? Like, who's actually being counted? And maybe even more important, who's being left out? Here's how we're going to break it all down. First, we'll look at what that unemployment rate doesn't tell you. Then, we'll get into the four different types of unemployment. After that, we're switching gears to your buying power and inflation. And finally, we'll wrap up with the hidden costs of rising prices. All right, let's get into it. Section 1. That single percentage you see in the headlines, we're about to deconstruct it and figure out the real story it's telling. So first things first. To be officially unemployed, according to Statistics Canada, it's not as simple as just not having a job. You actually have to tick three very specific boxes. You've got to be not working, of course, but you also have to be available to work. And this is the key part. You have to have been actively looking for a job in the last 4 weeks. Okay, so you take that group of people who fit the official unemployed definition, and you add them to everyone who is working. Together, that whole group is what economists call the labor force. It's basically the entire pool of people who are either working or trying to find work. And this is where that headline number comes from. The math is pretty straightforward, actually. You just take the number of unemployed folks, divide it by the total number of people in the labor force, and then multiply by 100 to turn it into that percentage you see on TV. So when you plug in some real-world numbers, you can see exactly how it works. You take, say, 1.364 million unemployed people, divide that by a labor force of about 19.3 million, and voila, you get a specific rate, in this case, 7.1%. But is that it? Is that single number the whole story? Well, not exactly. As neat and tidy as that percentage seems, it can actually hide a lot of what's really going on in the job market. And this is where things get really interesting. Think about it. That rate doesn't count discouraged workers. People who want a job but have gotten so frustrated they've just stopped looking. They're not in the labor force anymore, so they're invisible to this number. And what about underemployment? The rate doesn't tell you if someone is working just 10 hours a week when they really need and want 40. To the official stat, they're just employed. Okay, so moving on. We've seen that the number itself is more complex than it looks. But it goes deeper. The reasons people are unemployed are also really different. It's not just one big blob of unemployment. There are different stories here. Economists usually slice it into 4 types. Let's look at the first 2. You've got frictional unemployment. This is totally normal, healthy stuff. It's just the short-term gap when you're moving from one job to another. Then you have structural unemployment, and this one's a much tougher nut to crack. This is when there's a serious mismatch between the skills people have and the skills companies are actually hiring for. The other 2 are pretty easy to grasp. There's cyclical unemployment. This is the kind that shoots up when the whole economy hits a rough patch, like during a recession. And last, you've got seasonal unemployment. This one's super predictable, right? Think about landscapers in January or ski instructors in July. It's tied to the time of year. This example with the TV news workers, it just perfectly captures structural unemployment. Imagine you're a specialist in TV news production and you get laid off. Your skills are super specific. It's not that there are no jobs out there, but there might not be jobs that need your particular expertise. That's a structural problem. So when you put all this together, it leads to a really cool idea called the natural rate of unemployment. Because you're always going to have some frictional and structural unemployment, people changing jobs, industry shifting. It means the unemployment rate can literally never be 0. So even when you hear politicians talk about full employment, it doesn't mean 0%. It means we're down to that natural, unavoidable level. All right, let's switch gears completely. We've covered jobs. Now let's talk about the other big number that hits you right in the wallet, inflation. This is all about your buying power. So how do we even measure inflation? The main tool is something called the Consumer Price Index, or CPI. The concept is actually pretty straightforward. Imagine statisticians create a virtual shopping cart, a basket, filled with all the stuff a typical family buys in a month. We're talking everything from groceries and gas to haircuts and movie tickets. Then they just track the total cost of that exact same basket, month after month, year after year. Here's a super simple example of how that works. Let's say our basket of goods, eye exams, pizzas, books, costs a total of $750 in our starting base year. Now, we flash forward to the current year. We're buying the exact same stuff, but because prices have gone up, that same basket now costs $900. See, the stuff didn't change, just the price tag. From there, the math is simple. You just take the cost in the current year, the $900, and divide it by the cost in the base year, the $750. Multiply that by 100, and you get an index number. In our example, it's 120. That number, 120, is a quick way of saying prices are 20% higher than they were in our base year. Okay, but who cares about an index number like 120? Why does it matter to you? Well, in our final section, we're going to connect this directly to your money and uncover some of the hidden ways inflation affects you. This is where the CPI gets really powerful. It lets us compare money over time. And check out this example. It's pretty mind-blowing. A salary of $30,000 back in 1990 had the same buying power as about $48,000 in 2015. That's inflation in a nutshell. It's like a silent thief, slowly eating away at the value of every dollar you have. And it's not just about your salary. It hits your savings, too. You know that interest rate the bank advertises? That's called the nominal rate. But to figure out if your savings are actually growing, you have to subtract the inflation rate from it. What's left is the real interest rate, and that's the number that tells you if your buying power is truly going up. So you can see how inflation causes all sorts of trouble. It punishes savers by devaluing the cash they're holding. It can really hurt people whose paychecks aren't keeping up with rising prices. And when inflation is all over the place and unpredictable, it just injects a ton of risk and uncertainty into the whole economy for everybody. And this all kind of leads to one last big question to chew on. Imagine a world where everyone's salary automatically went up by the exact rate of inflation. If prices and wages rose together, perfectly in sync, would inflation even be a problem? Is the real issue the rising prices themselves, or is it the fact that for most of us, our paychecks just can't keep up? Something to think about.